Well, folks, we've got another economic study on our hands, and this one is a bit of a doozy in terms of the assigned net present value. Today, we're talking Aris Mining's 51% Soto Norte project, which is found in Santander, Colombia. The company has released a quite positive pre-feasibility study on the project, which rejigs the go-forward plan for the company, with processing capacity literally halved from the prior plan. But with this gold environment, it still gives them a multi-billion-dollar net present value, despite over 20% of capacity not even dedicated to their own operations. Sounds intriguing, right? Let's dive in. Aris Mining has finally completed a pre-feasibility study on their Soto Norte project. Initially expected to be delivered in the first quarter of 2025, the roots of this study date back as far as May of 2024, when Aris increased their ownership in the project to a majority position. At that time, the company increased their position in Soto by 31% by giving 9.9% of their cap stack to Mubadala, an Abu Dhabi-based investment group and Aris's joint venture partner in the project. In connection with that purchase, Aris at the same time basically said that the current operational plan for Soto Norte simply wasn't going to work. Originally envisioned as a 7,200 ton per day operation, Soto was expected to be just shy of a Tier 1 asset, with annual production of about 450,000 ounces of gold over an 11-year period at an AISC of just $471 an ounce. But that plan had its problems. First, the mining method required a lot more waste for backfill purposes. Second, the original plan called for a 6.9-kilometer long tunnel to be bored, which was expensive and was also expected to extend construction timelines, with the timeline to production heavily dependent on how long this process took. Third, the expected footprint for this processing facility was larger than Aris was comfortable with. And then there was the initial capital, which was pegged at $1.2 billion in 2022 dollars. Fast forward to today, and well, Aris still plans to get all those ounces out of the ground, but at a reduced rate annually in favor of long-term production, which also benefits them on the messaging side. First, they get to say they are being environmentally friendly due to the smaller footprint above ground for surface operations, and second, because it promotes long-term careers in Colombia. Anyways, let's take a closer look here at what Aris has proposed. The revised plan for Soto Norte calls for an operation with an initial 22-year life of mine, producing on average 203,000 ounces of gold in concentrate per year. The underground mining operation, as has become standard in the sector, expects to have higher levels of production up front, with years 2 through 10 expected to have average annual production of 263,000 ounces. Over the life of mine, a total of 4.3 million ounces of gold, 18.8 million ounces of silver, and 84 million pounds of copper are expected to be produced, which is based on grades of 7 grams per ton gold, 32 grams per ton silver, and 0.2% copper. On the mining side of things, the underground mine is expected to produce ore at a rate of just over 2,700 tons per day via longitudinal open stoping with backfill. 2 parallel zones of gold, silver, and copper mineralization will be mined here, referred to as Gigante and Mascota. Those zones are expected to be mined over a strike length of 1.8 kilometers and 1.6 kilometers respectively, down to a depth of 700 meters. Mined material will then be transported to the processing plant via an aerial rope conveyor, which will reduce truck traffic, road dust, and the risk of spillage into waterways. The process plant itself is to be sized at 3,500 tons per day, which is notably 750 tons per day larger than mining operations. This oversizing is a function of ESG initiatives, with the process plant expected to have 750 tons per day of capacity dedicated to processing mill feed purchased from local contract mining partners to support artisanal mining in the area. The process plant is expected to produce a total of 3 saleable concentrates, including gold-rich copper concentrates, pyrite concentrates, and gravity gold concentrates, with no cyanide or mercury to be used in the entire process. No on-site smelting or refining will take place here, with Aris leaning heavy on the ESG angle of reducing harmful emissions or chemical residues by electing to forego these processes. Recoveries, meanwhile, are estimated at 92.8% for gold, 88.8% for silver, and 92.8% for copper. So, how do things look from a cost perspective? Well, compared to the $1.2 billion initial capital figure under the old plan, this new plan looks rather cheap. Initial capital here is pegged at half the original figure, coming in at just $625 million, which includes pre-production costs as well as $34 million in value-added tax and $54 million in contingencies. Broken out a bit, mining capex amounts to $56 million, while surface expenditures are estimated at $400 million, including $172 million in infrastructure and $96 million for the process plant. The remaining $170 million comes from the other bucket and includes $73 million in expenditures on resettlement and environmental monitoring costs. Deferred and sustaining capital expenditures add a further $364 million to capital requirements. On the operating side, life of mine operating costs are estimated at $2.5 billion, including $393 million in royalties that are to be paid out. The bulk of this attributable to production, while pre-production costs are estimated at $37 million and post-production costs are estimated at $10 million. On a per-ounce basis, over the life of mine, cash costs are expected to amount to $345 per ounce sold, while all-in sustaining costs are pegged at $534, making this one of the lowest cost producers globally should things go to plan. Which leads us to the economics of the project. With a low cost of production and a sizable production profile, you can probably imagine how this one is going to shake out in terms of net present value. On an after-tax basis, the net present value here is estimated at $2.7 billion, with an internal rate of return of 35.4% and a payback period of just 2.3 years. That estimate is based on $2,600 an ounce gold and a 5% discount rate. Average annual EBITDA, meanwhile, is expected to average $410 million over that entire mine life. At $3,200 gold, the NPV jumps to $3.6 billion, while the IRR rises to 42.1% and the payback period falls to just 2 years. And given the fact that the spot price of gold is currently hitting new highs nearly $400 north of that figure at the time of recording, well, you can probably guess what the real value of this project is in a gold environment like this. A lot. Okay, so let's wrap it up. Now, when you see a project with numbers like these, we got to expect the project's going to move forward. We got per ounce metrics that are so low that it's hard to imagine that someone isn't going to build this project. As it stands, Aris says that they are in the process of completing environmental studies with the aim of applying for an environment license in early 2026. Given the major emphasis that Aris has placed on supporting the community under this pre-feas, it wouldn't be shocking to see an accelerated timeline for those permits to magically fall into place. Then it's just a matter of completing the resettlement obligations before construction can begin on this project. That might sound fairly quick, but as this technical report itself states, Soto Norte remains several years away from development. All right, everybody, thanks for watching. If you enjoyed this video, do me a favor, smash that like button, subscribe, and ring that notification bell. Also, if there's other stories you want us to cover, as always, let us know in the comments section. We are always looking for ideas. And also be ready because we got some big videos coming on our channel this week from Beaver Creek. All right, everybody, thanks for watching.